Hey everyone, we have entered 2026 on a not so great note. Markets have been under pressure after the latest 500% tariff drama. Now if you step back and look at the bigger picture, it's now been close to 16 months since the Indian stock market has been underperforming and market has been testing investors' patience big time. But what is interesting is, fundamentally India's outlook is not weak. Our GDP growth has been decent, inflation is very low, government has cut taxes, and RBI has cut interest rates and injected massive liquidity into the system. So on the domestic macro side, things are actually quite supportive. The single biggest drag right now is geopolitical uncertainty, especially the Trump tariff. On top of this, the weakening of rupee has hurt India's return in dollar terms. That combination has led to massive FII outflow. While domestic flows via SIP and lump sum investment have done a fantastic job of supporting the market, the reality is that consistent FII selling has completely shifted the market momentum from bull to bear territory. Honestly speaking, it was not just global uncertainty. The biggest factor has been extremely high valuation for Indian market after the massive rally post-COVID. But now that we have seen a consolidation and correction for 15-16 months, valuations have become better. Still not cheap though. So at the moment, I want to say is, first of all, volatility is not new. It's part of equity investment journey. And as far as macro events are concerned, there's nothing that we as individuals can do about it. What we can control is our process. We can focus on researching good businesses, identifying opportunities during this uncertain phase, and building a portfolio that can remain resilient even when the market mood is weak. Because this is not the first time when Indian markets have struggled. In last 25-30 years, we have seen many crazy events. Yet, Indian markets have created massive wealth for the investors. So personally, rather than focusing too much on macros, I am spending a lot of my time on research. And recently, I read Motilal Oswal's latest India strategy report. It is a massive 300 plus page report covering multiple sectors and detailed analysis of companies within each sector. In this report, they have highlighted their top 5 ideas from Nifty 50 universe and top 5 stock ideas from Nifty non-50 universe. And that's exactly what I want to discuss today. Since there are 10 stock ideas, I thought of breaking this video in 2 parts so that we can discuss about each business without stretching the video length too much. So this is the first part of the video where we'll cover Motilal Oswal top 5 Nifty 50 stock idea. In the second part, we'll cover the top 5 Nifty non-50 stock idea. But before we proceed, let me clarify that please don't take these names as buy call. Make sure that you do your own research before investing your hard-earned money. Alright, let's get started. So first stock pick is SBI Bank. When Motilal Oswal include SBI in its top ideas, it is essentially a call on Indian credit cycle, not just one bank. SBI today is very different from what it was 5 or 6 years ago. Back then, the bank was dealing with stressed assets, corporate NPA, and constant fear around balance sheet quality. That phase is largely behind us. The biggest positive for SBI right now is its asset quality. Gross and net, both NPAs have come down meaningfully and incremental slippages are under control. This has a direct impact on profitability because lower stress means lower credit cost. And when credit costs fall, earnings don't just grow linearly, they expand sharply. On the business side, loan growth remains healthy and well diversified. SBI is not over-dependent on any single segment. One of SBI's biggest structural advantage is its deposit franchise. It is the largest and most stable deposit base in the country. A significant portion of its deposit are low-cost CASA deposit, which helps keep the cost of fund under control. In a falling interest rate environment, this becomes even more powerful because banks with strong deposit franchise are better positioned to protect their margins. Another angle that often gets missed is the subsidiary values. SBI owns significant stake in SBI Life, SBI Card, SBI Mutual Fund, and SBI General Insurance. These are high-quality, profitable businesses on their own. Over time, as these subsidiaries grow and potentially unlock more value, they add a hidden layer of upside that is not always fully reflected in SBI's core banking valuation. Now from valuation perspective, SBI is still not expensive related to its earning potential and balance sheet size. The market continues to price it cautiously due to its legacy concern, but as consistency in earning and asset quality continues, that perception can gradually change. Even a small re-rating combined with earning growth can deliver meaningful return. As far as key risk is concerned, it mainly remains macro-driven. A sharp economic slowdown, unexpected asset quality stress, or aggressive competition in retail lending could impact companies' profitability. In short, SBI is no longer a turnaround story. It's a normalized, scale and systematically important bank that stands to benefit if India's credit growth remains healthy over the next few years. Second stock is Titan. Now, Titan is essentially a long-term play on India's rising discretionary consumption and premiumization trend. While most people immediately associate Titan with jewelry, the reality is that it has built a diversified lifestyle business over the years, with jewelry, watches, eyewear, and newer category all contributing to growth. Of course, jewelry remains the core driver. Tanishq has become one of the most trusted jewelry brand in the country. Even when gold prices are volatile, Titan has shown the ability to grow volumes because customers are increasingly shifting from unorganized jewelers to organized jewelers. This formulation trend works strongly in Titan's favor over the long term. One important tailwind for Titan right now is the recovery in discretionary spending. With tax cut improving disposable income and inflation remaining low, consumers are more willing to spend on lifestyle and aspirational products. Also, the fact that consumer behavior around gold is changing. People now increasingly believe that gold prices are structurally high and they are unlikely to come down meaningfully. So instead of waiting endlessly for prices to cool off, they are advancing their purchase. Beyond jewelry, the watches and wearable business continue to do well for Titan. Eyewear is still a smaller part of the business, but it is growing faster. As far as key risk is concerned, one of them is prolonged high gold prices that can affect the demand, then short-term margin volatility, or a sharp slowdown in discretionary consumption. But structurally, Titan remains one of the cleanest and most predictable ways to play India's consumption story. Having said this, valuation is one key concern with Titan. Its stock usually trade at a premium because the market assign a high quality multiple to consistency, governance and brand strength. In the short term also, Titan should sustain high valuation due to excellent Q3 update where its consumer business revenue has jumped 40%. Structurally also, Titan remains one of the cleanest and most predictable way to play India's consumption story. Then third stock pick is Mahindra & Mahindra. Now Mahindra & Mahindra is a stock that sits at the intersection of rural recovery, auto upcycle and strong product execution. On the automotive side, Mahindra has executed extremely well in the SUV category. Models like Scorpio, Thar and XUV have become strong brand and they've got a strong long waiting period, which indicates sustained demand rather than short-term hype. But it is not only the auto engine that is firing. Company's tractor division is performing even better. In latest December sales data, its tractor segment has grown 39% year-on-year and auto segment has grown 23%. Mahindra is also investing in EVs, but in a very calibrated manner. It is not burning capital aggressively, nor it is ignoring the transition. Valuation-wise, Mahindra & Mahindra is not cheap, largely because the market has already recognized the turnaround and strong execution. However, company's good earning visibility, strong order book and its rural linkage provides a good comfort that Mahindra growth is not purely cyclical. The key risks for the company include a sharp rural slowdown, input cost inflation or increased competition in the SUV space. But overall, Mahindra today is much cleaner, better focused business than it was a few years ago. And it stands well positioned to benefit from both rural stability and urban aspiration. And that's what makes it a compelling pick for 2026. Then fourth stock idea is Infosys. Now Infosys represents a classic case of a high quality business going through a cyclical slowdown rather than any structural problem. Today, entire global IT service sector has been under pressure as clients have cut discretionary spending, delayed their decision making and are focusing more on cost optimization. That slowdown has resulted in big negative sentiment, but it hasn't broken the business model. Today, one of the biggest concerns on IT company is the impact of AI. There's a narrative that AI will kill IT industry. But if you research on this topic, you'll find that industry experts are considering AI as an opportunity for next wave of growth for IT industry. Yes, today there's a lot of uncertainty as clients are evaluating AI impact on their industry and technology is still evolving. So clients are not committing big investment at the moment. Having said this, it is just a pause. Once the clarity would emerge, every company will invest on integrating AI in their business. And that will create new revenue opportunity for IT sector. Yes, for long term, AI will kill the low-end commoditized service jobs, but at the same time, it will expand high-value consulting, transformation, and platform-led work. Companies that fail to move up the value chain will struggle, and companies that adapt early can protect their margins and stay relevant. I think Infosys is already embedding AI across its service line. Plus, integrating AI into companies' existing system, data and workflow would require deep domain expertise. And that's where Infosys have the massive advantage. As far as company's valuation is concerned, it has moderated compared to its peak optimism phase. While Infosys is not cheap in absolute terms, it looks more reasonable related to its own history and its earnings stability. If global tech spending stabilizes or even shows modest improvement in 2026, earning recovery should be sharper than what the market currently expects. As far as key risks are concerned, they are clearly macro driven. A longer slowdown in US or Europe, further tightening of IT budget, or pricing pressure from client could delay the recovery. But structurally, Infosys remain well positioned to ride out the cycle. Motilal Oswal's fifth pick is Eternal. Now, Eternal represents a very different kind of bet compared to the other large cap names on the list. It's a platform-led structural growth story tied to how Indian consumption and convenience are evolving. At its core, Eternal operates at the intersection of food delivery, quick commerce, and restaurant discovery. What is important to understand is that the business has moved beyond the phase where survival was the question. The focus today is clearly on unit economics, profitability, and disciplined growth. The food delivery business has matured significantly. Competition has also rationalized and discounting is far more controlled. Plus, the platform behavior has improved. Eternal now benefit from better take rates, improved delivery efficiency, and higher order frequency from repeat user. As companies' scale increases, incremental orders are far more profitable from the early years. While its food delivery business was the growth driver in the past, today the biggest growth driver for the company is its quick commerce division. Although it is still an investment-heavy segment, but consumer adoption has been much faster than expected in this quick commerce division and is clearly visible in last few quarters of massive growth. And it's expected that quick commerce will continue to grow at much faster rate. The only point of debate is valuation. First of all, you cannot measure Eternal valuation on traditional parameters like PE ratio. But even on price to sales metric, valuations are elevated. One of the biggest reasons is Eternal has become a favorite of many fund houses in India. But this stretched valuation exposes Eternal to execution risk. Any misstep in profitability, regulatory issue, or aggressive competition can hurt the sentiment quickly. In simple terms, there is no doubt that Eternal is a bet on changing consumer behavior in India, where convenience, speed, digital platform increasingly dominate everyday decision. Although it is high risk as compared to traditional large cap, but it also offers a different kind of growth opportunity for 2026 and beyond. Having said this, valuations are always debatable and execution risk is real. So that's part 1 of Motilal Oswal top 5 Nifty 50 ideas for 2026. If you look at these businesses together, one thing becomes clear. These are not momentum trades or short-term bets. Each of these companies represent a different pillar of India's long-term growth. Banking and credit through SBI, discretionary consumption through Titan, rural and auto recovery via Mahindra & Mahindra, global tech services through Infosys, and platform-led consumption through Eternal. At the same time, it is important to be realistic. Just because a stock is part of a strategy report does not mean it will perform immediately. Markets can remain volatile longer than we expect. FIs can continue selling and headlines can stay negative. But that's just how cycles work. But phases like these are usually when long-term portfolios are quietly built. Not when everything feels comfortable, but when uncertainty is high and sentiment is weak. The key is not to rush, not to overreact, and not to blindly follow any stock name. Use ideas like these as a starting point, not as an end point. In part 2, we'll go through Motilal Oswal top 5 non-Nifty 50 ideas where it is slightly higher risk, more growth-oriented business, and very different drivers compared to large caps. That's where things get more interesting, and also where stock selection matters even more. So if you found this video useful, make sure to watch the second part. And as always, do your research before investing with a long-term mindset. I'll see you next video. Till then, take care.